Hello everyone, and welcome to my channel where I share with you some insights and tips on how to invest wisely in 2023. Today's topic is, when is the right time to invest in stocks in 2023? As you may know, 2022 was a turbulent year for the stock market. We saw record highs followed by sharp drops. We witnessed unprecedented inflation and interest rate hikes, and we faced global challenges such as COVID-19 variants, supply chain disruptions, and geopolitical tensions. So what can we expect for 2023? Well, according to some experts, there are some key trends that will shape the stock market performance next year. Here are some of them. 1. Inflation will remain a major challenge for the economy and the Fed, which may continue to raise interest rates and taper its bond buying program to cool down price pressures. This means that borrowing costs will increase for consumers and businesses, which may reduce spending and investment. 2. The stock market may face a correction or a bear market as economic growth slows down, earnings growth decelerates, valuations become stretched, and geopolitical risks increase. Historically speaking, corrections happen about once every year while bear markets happen about once every 6 years on average. Some of the factors that could trigger a correction or a bear market in 2023 include a policy mistake by the Fed that tightens monetary conditions too much or too fast, a resurgence of COVID-19 cases due to new variants or vaccine resistance, a trade war between China and the US or other major economies, a military conflict involving Iran, North Korea, or Russia, a cyber attack on critical infrastructure or financial institutions. 3. Alternative investments such as commodities, real estate, private equity, and hedge funds may offer diversification benefits and higher returns in an inflationary and volatile environment. Alternative investments are assets that are not stocks, bonds, or cash. Some of the alternative investments that could perform well in 2023 include commodities such as gold, silver, oil, copper, and agricultural products. These tend to benefit from rising inflation, supply shortages, and strong demand from emerging markets. Real estate such as residential, commercial, or industrial properties. These tend to generate steady income from rents, appreciate in value over time, and hedge against inflation. Private equity such as investing in startups, buyouts, or venture capital funds. These tend to offer higher returns than public markets, but also higher risks and lower liquidity. 4. Savings bonds may become more attractive as interest rates rise and inflation expectations moderate. Savings bonds are debt securities issued by governments that pay fixed interest rates and return the principal at maturity. They are considered safe investments because they are backed by governments and have low default risk. Savings bonds may become more appealing in 2023 for two reasons. Interest rates may rise further as the Fed continues its tightening cycle and other central banks follow suit. This means that savings bonds will offer higher yields than they did in previous years when interest rates were near zero or negative. Inflation expectations may moderate as supply chain issues are resolved, consumer demand normalizes, and fiscal stimulus fades. This means that savings bonds will preserve their purchasing power and protect against inflation erosion. They offer tax advantages, flexibility, and low minimum investment requirements. 5. The labor market may face some headwinds from layoffs, skills mismatch, automation, and immigration policies. The labor market was one of the bright spots of 2022, as unemployment fell to pre-pandemic levels, wages rose across sectors, and job openings reached record highs. However, there are some challenges that could affect the labor market in 2023, such as layoffs due to business closures, restructuring, or outsourcing. Some industries that could be hit hard by layoffs include retail, hospitality, travel, entertainment, and media. Skills mismatch due to changing demand for workers' skills, education, or experience. Automation due to technological innovation, cost reduction, or efficiency improvement. Some jobs that could be replaced or augmented by automation include clerical work, customer service, manufacturing, transportation, and agriculture. Immigration policies due to political agendas, national security concerns, or economic interests. Some immigration policies that could affect the labor market in 2023 include visa restrictions, border controls, deportations, or amnesty programs. 6. Cryptocurrencies may recover from their slump in 2022 if they can overcome regulatory hurdles, environmental concerns, and cyber attacks. Cryptocurrencies are digital assets that use cryptography to secure transactions, control creation, and verify ownership. Cryptocurrencies had a roller coaster ride in 2022, as they reached new highs followed by steep crashes. Some of the factors that influenced their price movements include regulatory hurdles such as bans, taxes, or restrictions imposed by governments or central banks on cryptocurrency trading, mining, or usage. Environmental concerns such as high energy consumption or carbon emissions associated with cryptocurrency mining or transactions. Cyber attacks such as hacking, phishing, or ransomware attacks targeting cryptocurrency exchanges, wallets, or users. So when is the right time to invest in stocks in 2023? Well, there is no definitive answer to this question, as different investors have different goals, risk appetites, and time horizons. However, here are some general tips that could help you make better investment decisions in 2023. Do your homework before investing in any stock. Do your research on its fundamentals, performance, and prospects. Look at its earnings, revenue, growth rate, profit margin, dividend yield, and valuation ratios. Compare it with its peers and industry benchmarks. Read its financial reports, news articles, and analyst ratings. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different sectors, geographies, and asset classes. This will help you reduce your exposure to market volatility and specific risks. Balance your risk and return. Don't chase after high returns without considering the risks involved. Don't avoid risks altogether either. Find a balance between risk and return that suits your personality, preferences, and objectives. Be flexible and adaptable. Don't get too attached to your investments or too rigid with your strategies. Be ready to adjust your portfolio or change your course of action when market conditions change or new opportunities arise. Learn from your mistakes. Don't let emotions cloud your judgment or influence your decisions. Don't be afraid to admit when you are wrong or when you need help. Learn from your mistakes and improve your skills over time. So these are some of the trends and tips that could help you invest wisely in stocks in 2023. I hope you found this video helpful and informative. Thank you for watching.